Hello learners, and welcome to today's lesson. In this lesson guys, we're going to do the accounting equation. So it means now on your side, you definitely need to make sure that you watch this recording up until the end. Okay, so before you watch guys, likewise please make sure that you like, you share, you subscribe and repost my videos, so it will help me to create more content that will assist you. So here's question 1 guys, where we need to do the accounting equation and also fixed assets. But on our side, we're going to only focus on the accounting equation. Then I will upload the part 2 of this recording where I do a practical example now of fixed assets. So you definitely need to make sure that you'll watch that video as well. So 1.1, the accounting equation. Here we're told that we need to complete the table provided to indicate the effect on the accounting equation for the following transactions. So where's the table that they are talking about? Here's the table guys that we're going to use to write obviously our answers. And then we need to note that the bank balance is favorable and the perpetual inventory system is in use for all transactions. So if the bank balance is positive guys, is favorable, it means it is positive. We have money in our bank account. And then additionally, we are told that the perpetual inventory system is in use for all transactions. Perpetual inventory system guys, it means now this is the inventory system where we constantly, every time if we are making any sale, we immediately update the value of the trading inventory. We don't wait. If we're buying trading inventory, we immediately update the value of the trading inventory. We don't wait. Okay, so we continuously update the value of trading inventory after each sale or after each purchase. Okay, so we're even given an example of how we need to analyze the transaction. For example, issued a receipt for rent received. So I'm definitely sure on that table we're even shown how that transaction was analyzed. Here, issued a receipt for rent received. So we're receiving a rent. So obviously guys, if we're receiving rent, what will happen? Our assets will increase. As you can see, asset A plus. Rent received, that is rent income. Income, they have a positive impact on owner's equity. Then you add on owner's equity, and then there is no impact on liabilities. So if there is no impact, guys, no effect, we need to just write a 0. So let us go to the actual transactions that we need to analyze. Transaction A, one of the partners contributed a delivery vehicle as part of his investment in the partnership. So what is happening here? Partnership. One of the partners decided to do what? To contribute. How is the partner contributing? Contributing to the partnership by giving the business a delivery vehicle. So definitely guys, our vehicles are increasing, our assets are increasing. So this is what will happen. Assets are increasing, plus on assets. The owner is contributing this delivery vehicle as part of his investment to the business, to the partnership. So what will happen to owner's equity? Capital is increasing, you go and add. Okay, any impact on liabilities? There is no effect on liabilities. So I hope you understand that transaction. And then B, credit note received for damaged equipment returned. So what happened here guys? Let me read again. Credit note received for damaged equipment returned. So what happened again? We purchased an equipment on credit from whoever the name of the business, but we as a business, we purchased an equipment on credit. So what happened when we purchased this equipment on credit? Assets increased because we were purchasing an equipment. Also liabilities increased because we owe someone as a result of buying an equipment on credit, but we have actually returned this equipment because it was damaged. So we need to reverse what happened first. So look what will happen guys. Here our assets are decreasing because we are returning an equipment that we bought on credit. Okay, so assets are decreasing. There is no impact on owner's equity. What will happen to liabilities? You need to think about what happened first. First, liabilities increased because we purchased an equipment on credit. But now we are returning the equipment that we bought on credit, which means now we need to reverse that increase on liabilities by decreasing them. We no longer owe because we have returned the equipment. So I hope that transaction also makes sense. And then the last one, repairs to buildings were debited to the land and buildings account in error. This must be corrected. So we definitely need to correct this. What transpired? What happened? Repairs to buildings were debited to the land and buildings account in error. So repairs took place. Whoever was doing repairs, they were repairing the building, but instead of recognizing an expense, what actually happened? We increase our land and buildings. Let me even write a T here. Land and buildings. Land and buildings were increased. But no, this is an expense. We're not buying more land. We're not buying more land here. So this is what we need to do, guys. Since our land and buildings were increased by mistake, we need to go and decrease our assets. We're decreasing our land and building. So repairs on land and building, an expense. Expenses, guys, they have a negative impact on owner's equity. Then you go and reduce the owner's equity. There is no effect on the accounting equation. So I hope, guys, you did gain some information here, and hopefully, guys, you did like, you did share, and you're going to repost my videos, you subscribe, so that I can get to create more educational videos that will assist you. So if you want online classes, here's my number, and then per month, guys, I charge an amount of 100 rands. Then you are going to attend for 2 hours weekly, and then in total it means now you're going to have 4 classes in a month where you are going to attend 2 hours each week for only 100 rands a month. All right, so thank you, guys. I will see you on the next one.